This is an Evergreen Media Network studio production.
Hey everyone, happy Valentine's Day and happy Ash Wednesday also on the same day. In any case, I'm going to be your host today, as in Janine has the flu, believe it or not, poor thing. We're going to pray for her today and hopefully she gets better quickly. We have a special guest today, and again, we're talking silver linings, and we're looking, this is kind of like the financial edition, if you will, and how to help with your financial wealth. So today we're talking with Mr. Mike Puck, and Mike has been a superstar in the financial world. And when we talk about the financial world, you know, really there's a lot of aspects to it. But what we're looking at now is we're seeing higher interest rates, so people are getting pretty much excited about the CDs that you can get at the bank. But there's other alternatives. There's things that we can do that maybe could do better than that, and hope generate more income than what you can get from just your typical bank CD. And Mike is the expert, was the lead trader at TD Ameritrade, and now he works for a company called Zega Financial. And Zega is just awesome. They really go out of the box in their thinking, and I just couldn't be happier that we have Mike on the show with us. Mike, can you hear with us?
Yep. Hey, Mike, good morning. I'm excited to be here. Thanks for having me.
Yeah, I'm glad you're here. And when we're talking about alternative solutions for a lot of people, you know, they really depend on their income that they can get from their investment plans, and they're worried because we're having a pretty volatile market, and so the markets are up and down, and so they're looking for something that could be maybe a little steady, but they need more money because what do we have? We've got a thing called inflation, right? So that's where we're at, and that's where you come in, because you're really kind of the expert. Not kind of, you are the expert on that type of investing. And so could you share with us a little bit about some of the things that you're doing at Zega that could maybe help people like that?
Yeah, sure. Why don't I start just with a little background? Like you mentioned, a trader at TD Ameritrade for a number of years. And I started before that. I was actually on Wall Street in New York, where I was a crude oil trader
Wow.
back during a tough time, back in 2008, 2009. So, but I've been in the trading world for about 17 years now. And we have a very experienced team at Zega that looks at the markets. And it is an interesting time, like you mentioned, with interest rates. All of a sudden, for the first time in years, there's a quick picture of our team, right? We're about 12 people on the Zega Financial team, and there's a picture of us ringing the bell in New York. So that was a lot of fun. We from time to time get to ring the bell, but our team has really grown. And just to continue on our firm a little bit, is we manage about $2.8 billion in assets. So that's a good sized money manager. And we focus on a couple different things like alternative income as well as protected growth. And the alternative space is really what makes sense to us the most. And that's because of interest rates. Like you said, Mike, we're looking at where interest rates are and how all of a sudden CDs look appealing for the first time in maybe 10 years. So, you know, you can go down to the bank and get a 4 or 5% CD, and that's just been impossible, for the past decade or so. So that seems really good on the surface. But what we really think about is, okay, great, you can get 4 or 5% CDs, but why are banks paying that much, right? Why are they paying 4 or 5%? Well, I think we all know the answer, and that's because inflation has been much higher. So interest rates have had to go higher. And because of that, we think that there's some opportunities out there to make more than 4 or 5%, right? Because if you're getting 4 or 5% from CDs, inflation is 3, 4, 5%, maybe a little bit more in some places. You want to look for opportunities that can make more than what that bank CD is making, and I think that's where we come in with some of our strategies.
Yeah, they really are spectacular strategies. I know them well, and man, it's so out of the box thinking. But I guess one of the positives for the CD, at least from the mindset of people that are going that direction is what they feel is the FDIC and the safety of a plan like that's in the bank. Obviously, there are drawbacks. Obviously, penalties to take it out early. There's that sort of thing. But what kind of assurance do we have with working with a different, unique kind of a strategy?
Yeah, so good question. This is very different than a CD. And we think CDs should be a part of your portfolio, right? If you have cash needs or if you want to be conservative with a certain part of your portfolio, we think you should go to the local bank or go to go to Mike or go to your local financial advisor and probably buy some CDs or some short duration bonds also could be a good alternative where you can get that 4 or 5%. And you're right, FDIC insurance or treasuries, right? That's backed by the U.S. government. So those are as safe as you can get out there. Where we think you should step into a little bit more risk to get a little bit more return is that next bucket of money, right? After you have had enough with your CDs and you feel comfortable and your treasuries and that comfortable, safe money, very, very safe money, the next step, 1 or 2, 3 steps off the sideline, where you want to take a little bit more risk, but you're going to get a little bit more return. And that's where the alternative income space comes in. So our hypo strategy is something that we've been able to average about 9% per year. And it's not correlated to the S&P 500, the NASDAQ, the Russell, or the Dow, or even interest rates.
Hey, Mike? When you say non-correlated, that's a neat term that I think most people aren't familiar with. How does that apply to what we're talking about here?
Yeah, good question. So when it comes to correlation, think about that. Stocks and bonds are not correlated, right? When stocks go up, usually bonds kind of stay flat or go down. When bonds go up, that's usually because the stock market's going down. So those are non-correlated asset classes. And when you think about how to build your portfolio, you want different asset classes that correlate differently. Some of them move together, some of them move different, some of them move opposite, right? So when you're thinking about all the different buckets of money you have or how you want to be invested, it's good to have a non-correlated portfolio.
Yeah, but not only that, but what you're suggesting in Zega, it actually goes into like a 3-dimensional thing because your ideas really don't correlate with bonds or stocks.
Yeah, that's correct. So where we think we add a lot of value is you have the stocks, you have bonds and CDs in the conservative part of your portfolio. Now let's add this third bucket or this third dimension, like you said, Mike, where we want to say, all right, we're going to look at the options market and we're going to look at income from the options market, or we're going to look at protection, but right now we'll stay on income. And what we do specifically is we design a portfolio that's that non-correlated bucket right here. Here's your third part of the portfolio that is going to generate income. It's going to be more than what you're going to get in bonds, but it's not going to be correlated to the stock market, meaning if stocks go up, you're probably not going to go up in this portfolio. If stocks go down, you're not going to worry about going down in this portfolio. It's going to be a non-correlated asset class. And again, the more non-correlation you have, the better diversified your portfolio overall is. So this is that third bucket where we think you can get 9, 10, 11%, and it's not going to be predicated on what the stock market does, and it's going to give you more than what your bond portfolio or your CD or your treasury portfolio gives you.
That's really interesting, and boy, what an asset that would be. One of the things that people try to get the bigger return because they need it because of the inflation problem, but then they're worried about the volatility of the market. So if you could get that kind of return, wow, you could really, at the end of each month, you have bills to pay, right? And so it'd be nice to have a predictable kind of an income that can satisfy the needs, which would be the grocery bills, the mortgage, the light bill, all that stuff that comes in, and you can't do that through a volatile scenario. And the CDs, without penalty, that sort of thing, you can't just take your money out, and it's not enough because it's not keeping up with inflation. So really what you're suggesting is kind of puts that to rest.
Yeah, you brought up a really good point, right? Is the grocery bills, the filling up your car at the gas station, going out to dinner these days, we all know that it's gotten a lot more expensive. Even though, the government says inflation's coming down, and it is coming down, but it's still much higher than it was 3 or 4 years ago. And we've all experienced that in our pocketbook or in our wallet. And so that's why interest rates have gone up. And that's why you're able to access CDs now that have a higher interest rate than historically, or at least historically over the past 10, 12, 15 years. But we just don't think that it's enough. That's what our big concern is we think that CDs are good and you should have them. They should be part of your conservative portion of your portfolio. But we just don't think CDs are going to be able to do it. We don't think that they're going to really be able to complete the entire basket of your investment. We think you need more than what the local CDs are paying at the bank. And we think we can get you more than that. And realistically, our strategy is we're looking to actually double what CDs are paying. And that's really going to boost your overall return, which is going to help out with those day-to-day bills, like you mentioned, grocery store or going out and things like that. So the CDs are great, again, but you want to get a little bit more return. And so you have to take a little bit more risk and look at a different dynamic or a different bucket of investments. And I think that's where we come in, is we're going to be able to boost your overall performance of your portfolio.
Right. A lot of times people with the CDs, at least anyway, they're not taking into account that they pay taxes on those earnings. So your 4 or 5% CD is now really 2.5 to 3% CD, and so now that's not keeping up with inflation. So even though inflation, like you said, I believe is maybe starting to curb itself, at least the rise of inflation, where things have gone are not going to come back down. So things aren't going to get cheaper down the road here. Yeah, at best they'll stay the same.
Right. Yeah, and so just because we come out and say inflation's going down, that doesn't mean that it's going to go negative, right? That's what I think people get mistaken with. Inflation's already happened, so we're going to experience that. Costs are not going to go negative at this point. That would be negative inflation. Highly unlikely that happens. What the Federal Reserve is actually trying to do is just get inflation under control, getting it back to that rising at the 2 to 3% rate versus that 5, 6, 7, 8, 9% rate that it was a couple of years ago.
Right. Hey, I know we're getting ready to take a break here, but what I want to do is come back, and you've got some really interesting slides that we want to look at that hopefully will address exactly what you're talking about. And I think there's 2 strategies that we're going to look at, and I think that'll be really interesting. And I think it's things that people just have never seen. So they're getting it here on the Silver Linings. So are we ready for?
Go ahead and take a break.
We're taking a break.
At Sunshine Furniture, our 35,000 square foot showroom is filled with the largest selection of in-stock coastal furniture on the Treasure Coast. Dining and bedroom sets, occasional tables, sofas, sleeper sofas, love seats and chairs, and all the latest styles and colors from Tommy Bahama, Lexington, Hooker, Riverside, Universal, Four Seasons, Braxton Color, and Capri. We're the outdoor furniture experts and have hundreds of styles of any patio furniture you need, including a gallery of Berlin Gardens and Pollywood. We're having a big February clearance sale, which includes all Tommy Bahama and Lexington in stock or special order, 50% off. Sunshine Furniture, 1295 US 1 in Vero Beach, next to Planet Fitness. Family owned and operated since 1991. Visit our website at sunshinefurniturecasual.com, and don't forget to visit our outlet and sales store directly across the street.
Sunshine Furniture, the best in every way. Have a sunshine day. Sunshine.
Well, we're back, and Yeah, I'm filling in for Janine Barrows, who unfortunately is taking the flu. And boy, she sounded horrible this morning when I talked to her. So hopefully she's getting some rest, drinking lots of water, like I told her, and she gets better soon because we need her back here. You probably don't want me next week, I can tell you that. So anyway, we're here with Mike Puck, and Mike has given us a lot of great ideas and thoughts on alternative investing methods that uncorrelate us with the markets, which we think is a really good idea. So, like I said before the break, we were going to talk about some slides, some actual graphs that Mike can talk to and fill us in on maybe how this all works. So, glad you're back,
sure.
Mike.
Let's take a look. Take a look. There's two different ways that we feel are important, and two different types of strategies that we feel are important to building a strategy. Right? We talked about the alternatives and why those are important. And now let's jump into our first strategy, which is called Hypos.
It's coming.
Oh, okay, perfect. So there we go. So the first slide on this is what's called Hypos, and this benefits from a 95% chance of success, right? I don't know anybody else that if you're a gambler or you play checkers or something like that, if you have a 95% chance of success, that's usually pretty high. So the odds are in your favor. But like I mentioned, this strategy does not have interest rate exposure. It is a very liquid portfolio, so that can be something that's very beneficial here, right? CDs, typically you have to hold them to maturity to make the income. This strategy, you actually don't. You make about 1% per month, and it's also liquid every single month. So it has a lower volatility and not as long as a lockup term as a typical CD that might be 6 months or 12 months. So next slide here we go. Perfect. So this is actually how it works. And what you're looking at is the S&P 500. That's what that blue line is there, right? That's the market trading. And that purple cone right there is what's called our probability curve. And that's just a fancy way to look at the market from a trading perspective. And what we do is we actually we trade in those green little bars there on the outside. And what we do is we trade what's called a spread. And that spread generates us about 1%. And we put this trade on about every single month, as long as we see the opportunity to place that trade. And that's the idea here is that purple line there is a 30-day window. So we make about 1% every 30 days. And there's a 95% or 90, even more, 96, 97% chance of success that our trade will be successful. Now, it doesn't work every single month. That's why we're only averaging 9% versus 12%. But most of the time we get about 1%. Sometimes it's a little less, sometimes a little more. But that's the idea here, right? Is you have this non-correlated strategy. It's not correlated to stocks. It's not correlated to bonds. It's not correlated to treasuries or CDs. Our focus is to make 1% every month, regardless of what happens to the market. The strategy has actually never had a down year. And on the next slide, what I'll show you is a little bit of volatility here. This is 2022, for those of you who can see it. We actually made 5.6%. And that's when the bond market, so that's when treasuries and CDs and even fixed income here was down about between 8 and 13%. So this is a strategy that's non-correlated. I've used that term a number of times throughout this morning, and that's because even in this example, when those safest investments like treasuries and CDs were down, now remember, they just marked down. If you still held them to maturity, you still got your income and you didn't have to worry, but those marked down 13%, and our strategy that year was actually up 5.6%. So great year to have this third bucket, like Mike mentioned, right? You have the stocks, you have the bonds. Now you add this third component to help give you income. And we think by adding that, it gives you diversification, it gives you a higher amount of income, and it gives you more downside protection overall. So again, this shows a great way to add that third component. This strategy specifically is called buy and hedge. which is another way to approach the market. And this really what we look for is getting some type of equity exposure, right? So now, instead of just having stocks, bonds in our alternative bucket with what we call hypos, which is the income there, now we say, well, you need some stocks for growth, right? We know that interest rates, again, are up for a reason. That's because inflation's up. We know that CDs are good. Now we have the second component, which is this alternative income. But now we need a little bit more growth. So that third bucket or fourth bucket out after you've kind of accomplished everything with the conservative buckets and you need to be a little bit more aggressive, we think that this strategy makes a lot of sense. And it's called buy and hedge. And this is a great chart here that's on the screen. This specifically gives you a certain portion of the upside. So you usually get about 80 to 90% of the upside of the S&P 500, right? So if the S&P goes up about 10%, you should go up about 8 to 9%. If it goes up 20%, you should go up around 16 to 18%, right? So you can get a lot of growth here if it's a good year in the market. But what happens if the market's down, right? What we're looking at here is that the downside of that trough is that you put a protective zone in there, and that's what it's called buy and hedge. We put hedges on the portfolio so that if the market drops, we limit your losses between 8 to 10%. So if the market goes down 20 or 30, doesn't matter. You have downside hedges protecting the portfolio, so you shouldn't lose more than that 8 to 10%. Sometimes it's a little even tighter than that. It might be 5 to 10%. So again, this is for that last bucket. You want to be a little bit more aggressive. You've already bought your CDs. You've already bought your alternative income. Now you want to get some growth in the market. Our feeling is that you should invest to be a little bit more aggressive, but build in that downside protection piece so that, knock on wood, if the market goes down, you're going to be protected.
Hey, Mike, on that aspect, that really we're trying to build a financial program or a plan where you have the conservative of the 1%, which is totally uncorrelated, which we can generate income from on a regular basis, and we have the buy and hedge with money that is going to grow more, but we don't necessarily have to take that money now. So if we could wait, even though the market's down, you're not going to lose any money, because the only time that you lost money on that plan was if you sold during that down period. So they're going to be a small down period, but you're going to have up periods. So really holding on to it for a year or two, if the market's in a major funk, then you'd be fine, because you're depending on paying the groceries and the gas bill, through the other strategy. Yeah. So
right.
So
right. Yeah, absolutely.
So really, when we're planning, we really need to think about longer periods. A lot of times people say, I retired at 65 and my parents died in their 70s. So I don't have that much longer to live, because I'm going to be at the same period for them. But that's not necessarily true, is it? So
of course not.
So the point is, yeah, we're living longer and hopefully healthier, but that's what this show's all about, right? So, but we want to have your financial health in store. Really, when we're planning, I always plan for somebody living to at least age 100. And I know people say, "Well, no, my parents died early," but I can tell you, I have a small story I can share. One of my friends, his father-in-law, had a major heart attack when he was 55, and his father had died at 55. Well, my friend, he had a heart attack at 55, but he survived it. But his father didn't survive at 55. He did, in fact, pass, and so did his brother at 55. So when my friend's father-in-law had his heart attack, he figured the writing's on the wall. I'm not going to make it very much longer. And so he ended up spending all his money when he got out, figuring, hey, my time is short. Well, he's still alive today. He's 85, and but he's broke. So it didn't work out too well for him. I highly recommend, if you're 65 and retired, plan on living to be 100. So, because it can happen. So, but in any case, your strategies are great. Do you have another slide up there? I think we have one more. Ah, okay. So that was it. But anyway, that's kind of where we're at with that. And looking at your philosophies and are so different. Do you see any other brokerage houses or anybody else doing something similar?
Yeah, great question, Mike. So, not typically, right? We think most big brokerage firms like the Morgans and the Merrills and the kind of the bigger guys, they do things very standard, right? They're very standard strategies that they run, typical stocks and bonds. They might not, plan specifically for the conservative nature of a client or the alternative nature of the client. So, I think working with a smaller firm like ours can have a lot of benefits. I heard a great analogy recently, and Mike, you may have heard this recently, but right, you can go get a great sandwich at Walmart or Target, but you can go to your local deli and get a really, really good sandwich. So, that's what we think we are, is we're the local firm that can give you a lot more personalization and can give you something really good that you might not get in a big box store.
That's a great analogy, and unfortunately, it's the first day of Lent, and I can't go to the deli anymore, at least for the next 40 days. But you're going to see a brand new me in 40 days. Hopefully, I'll come on and I'll share that with you with a tank top. Maybe that's what I'll do. But hey, Mike, it is wonderful that you were able to come on board with us today, and I'm really thankful that you spent the time, because you are a wealth of knowledge. Zig is a wonderful company, and I just can't wait to do some more business. That'd be good, wonderful. So I want to thank everybody for joining. We do have some sponsors that we need to mention. One is Conway Financial. And the other, obviously, is Rooney & Rooney Law Firm. They are an awesome law firm, and they're all part of this show. They make it happen. And really, we missed Janine Burrows today, but she'll be back, and she is spectacular. So I want to thank everybody. Thanks for being here. Have a happy Thanksgiving. Oh, I'm sorry, Thanksgiving? No, Valentine's Day.